Hey guys, Dave Santarelli here. I just made a PowerPoint presentation as I promised you guys. Today I'm going to talk about the basic options trading, and in this video we're going to talk about the calls. Hope you find this informative and educational. If there's anything else you'd like to learn or for me to educate you on, just please comment below and we will discuss those in another video. Okay, call option. Call option is the right but not the obligation to buy a stock at a specified price at a specified date, known as the strike price and expiration date. Example, Facebook symbol FB is trading at or around $86 per share. You're bullish on the stock, which means you're thinking it will go up. You feel Facebook will be around $95 a share by the end of September. Excuse me. You go to your options chain from your brokerage firm and you look at the different strike prices. Right here is my E-Trade option chain. We have the symbol FB here. On top we have all the different expiration dates. We selected the September 25th. Here are your strikes. Your calls are on the left, your puts are on the right. We're looking at the $89 strike. And in this example here, the $89 strike last traded at $2.91 per contract. We have a bid of $2.90 and an ask of $3.20. If we went in and bought this right now, we probably wouldn't get it at $2.91. It'd probably be closer to $3 to $3.10 per contract. But in this video and explanation, we're going to stick with the $2.91. So you see that the $89 strike call for September 25th expiration last traded at $2.91 per contract. Since there are 100 shares per contract, you need to multiply that $2.91 by 100 to get the price it will cost you per contract. So in this case, it will cost you $291 to get one contract of Facebook calls, which for one contract gives you control over 100 shares of Facebook above the strike price, which in this case is $89. The break-even point. The break-even point for a call option is the strike price plus the cost per contract. In this case, the break-even point is $89 plus $2.91, which is $91.91. How call options make us money. The beautiful thing about options is that it's much easier to double our money than owning stock. In this case, what we need to double our money is simply double the amount we paid per contract plus the strike. So $2.91 times 2, we just need the stock to go up $5.82 to double our money. So 582 plus 89 equals $94.82. So in this example, we just need the stock to be at $94.82 at expiration day, and we doubled our money. If it happens sooner, within a week, 2-3 weeks, we're going to more than double our money because we have more time for the stock to go higher, which is known as extrinsic value, which I'm going to get into later on. Whereas if we bought the stock at $86, where it's currently trading near, to double our money, we need Facebook to get to $172 per share to see our investment make a double. The risk of a call or put, in this case a call option, is limited to what we invest into it. So in this case, one contract costs $291, so that is the most we can lose plus the cost of commissions. We would lose all of that investment if Facebook is trading below $89 a share at expiration date, which is September 25th. If Facebook is at $95 at expiration day, if it's at $91 a share, then the contract we paid $2.91 for would be worth $2. 91 minus 89 is 2. With Facebook at $99 a share, our 89 strike would then be worth $10 at expiration. Remember, we only paid $2.91 for it, so this is over a 300% gain at expiration. Like I said, if it happens sooner, these are going to be worth much more than $10 because we have extrinsic value, time value, which gives the stock much more time to go higher and make us more money. So the extrinsic value is going to be higher in the premium here. Do we need to keep the options until expiration? The answer is no. Most traders never keep their options until expiration. Most traders trade options just like stock. You know, If you keep it until expiration, that means it's going to get exercised and assigned to you. So say Facebook goes up $5 a share next week, that would mean Facebook's at $91 a share. Most would sell all or part of their contracts on a move like this, since it's a pretty significant move. It all depends on your personal preferences, if you think the stock's going to go higher, and how quick this kind of move happens. So it's all personal preference. Me personally, if I was bullish on the stock, I would keep it, or maybe just sell a couple contracts. Intrinsic and extrinsic value. Intrinsic value is the in-the-money portion of the option price. Example is if we have the $89 strike call and we paid $4.50 for it, and the stock is trading at $90.50, then the intrinsic value is $1.50, and the remaining $3 is time value, also known as extrinsic value. In our case, we bought the $89 strike, and since it's not in the money, it's OTM, all of the premium is extrinsic value. Like I said, time value. How do we know what the price of the strike will be on a given move? The delta tells us this. In this example, right here, we have the $89 strike, September 25th expiration, the call. The delta right here is 42 cents. So in this example, the $89 strike call, September 25th expiration, has a delta of 42 cents. So this means for every dollar the stock goes up in value, the strike's premium will go up 42 cents. So if Facebook goes up $5 next week, then the strike's cost premium will go up by $2.10. So instead of being $2.91 per contract, it would then be worth at least $5.01 per contract. And like I said, if it happens sooner, the extrinsic value is going to be higher, so this would be even higher than $5.01. How do I find my trades? It's very simple. Through many studies. I have at least 10 studies I look at. I have a few favorites. Here's one of them. It's a standard deviation channel. But I evaluate stocks on their daily, weekly, monthly, and yearly charts of each stock I'm looking at. Also from general market conditions, economic events, earnings events, and through the momentum of a stock and its sectors. Here's a typical study I use, like I said. It's a standard deviation channel. When I see a stock behave a certain way, like in this study, is a perfect example. I see Facebook is trading within the deviation channel here, the purple or magenta channel right here. If I seen this break here below the purple lower channel, I would get calls for it. If I see a break above here, then I know it's time to get some puts. I know it's going to retrace. So like I said here, this is the standard deviation channel. I noticed that Facebook trades within the two purple channels. When it reaches the upper limits or breaks the upper purple channel, I know puts are the best strategy. When it breaks below the purple channel, I know calls are the best way to play. But there are other things I look at, like the general market condition, what the market's doing, what the sector's doing, and look for events that might cause the stock to go higher or lower. So this is just one of the studies I use. There's many more charts I use. I wanted to make this video pretty short here. We're already at 9 minutes. So if there's anything else you guys would like to learn or me educate you on, please comment below. I would love to get into further advanced details for those of you that are experienced advanced traders. So if there's anything that you guys would like a video about, just please comment below and I will make some kind of video or PowerPoint presentation on it. I hope this video helped, should help the newer traders that are in the room. I had at least 15 people message me the past 2 days saying they trade stocks and they're looking to get into options and asking me, you know, to give them some kind of idea of what calls and puts are. So hopefully this helped you a little bit here. And if there's anything else, like I said, just feel free to ask and I will post it. Hope y'all are having a great weekend and looking forward to Monday. I really think the markets are going to go a little bit lower on Monday. I don't think it's a good time to start buying yet. The best thing to do is wait for the trend. You wait for the market to decide what it's going to do. Right now, the market's going down, so why go against the market? You know, if the market's going lower, there's no sense in fighting the market and buying calls for it. I always just go with the flow of the market. If the market's going higher, I stick with this long stocks and calls. If the market's going lower, I short or buy puts. So hope this helped, and have a great weekend, and God bless. Bye bye.